Welcome, everybody, to the Fuqua LinkedIn Live presentation today. My name is Rahul Vashishtha. I'm a faculty at the Fuqua School of Business. Last few years, I've been doing a ton of research trying to understand bank fragility in the US banking system. To what degree are these banks fragile? What are the sources of that fragility? That has been the topic for my research. And my objective today is to share some of the insights from that research I have done. And some of what I'll be talking about is also relevant to understanding some of what transpired a couple of months back in the regional banking crisis episode that we witnessed. So let me open my slides here at this point to guide you through some of the ideas that I'll be talking about. Okay. So upfront, first, let me clarify what exactly do I mean by bank fragility. Okay. To have everybody on the same page, the idea here I have in mind is the propensity of banks to experience these panic-based withdrawals by its depositors, which are very, very difficult to explain purely based on the fundamental health of the bank. Okay, so you can imagine these are very, very inefficient. They can potentially bring down even a fundamentally solvent bank. And in my research, I've been trying to understand to what degree does that occur in the banking system and what are the drivers of that. All right. So let me start by laying out some of the basic ideas for why banks are vulnerable to that kind of behavior by depositor base. Now, this is something very, very unique to banking industry. This is not something we necessarily see in other industries. So let me tell you this fragility, it goes back to the very core of banks' business model. Okay, so what do banks do? As we all know, banks are in the business of taking deposits and handing out loans. Okay, these are extremely socially desirable activities. Loans are important in the economy. They facilitate investments. They help people buy houses. Deposits, similarly, are very, very important. Everybody, corporates or individuals, need a temporary parking place for their cash, and deposit services are designed to do essentially that. Now, this basic business model of banks manifests very visibly in a bank's balance sheet. Okay, so what you're staring at on this slide is the balance sheet of a very typical bank in the United States. Okay, so you focus on the asset side for a moment, you will see more than half of the assets are essentially loans. If you go on the right-hand side of the balance sheet, you will see 3/4 of the funding for a typical bank tends to come from deposits, and then roughly half of that tends to be uninsured deposits. All right, so this is very, very consistent with the business model of the banks. Now, once you look at these balance sheet, you can see there is another way to characterize a bank's business model. Essentially, banks, you can see, are in the business of doing liquidity transformation. By that, what I mean is banks take essentially liquid financing in the form of deposits, and they are in the business of turning them into highly illiquid loan investments. Now, why do I call deposits as a liquid form of financing? Well, think of it from the standpoint of a customer. You can withdraw your deposit at any point in time. It's a highly liquid form of investments. Loans, on the other hand, you can imagine highly illiquid. Okay, they generate cash flows over longer horizon. There is no ready market for loans if you would like to dispose them. If a bank needs to dispose of the loan, they might actually have a very hard time finding a buyer, and even if they're able to sell a loan, they might not get a very good price. Okay, you can imagine there might be a bit of a liquidity discount if you're trying to dispose of loans. All right, so you can say banks are in the business of liquidity transformation, and it's a highly desirable, socially valuable activity, but it has a dark side to it, and I'm going to argue it very much lies at the core of what also makes banks fragile. Now, this point was made way back by Doug Diamond and Phil Dybvig in their seminal paper in 1983. By the way, this paper is one of the key reasons why these two researchers won the Nobel Prize for economics in 2023. And their seminal insight from this paper is, look, this business of liquidity transformation is valuable, but it also makes banks vulnerable to something called panic runs. Now, what do I mean by that? Well, panic runs refers to deposit withdrawals that are not necessarily triggered by their consumption needs or necessarily by their fear of banks' health per se. They're purely driven by fear of withdrawals by other depositors. So you can see these panic-based withdrawals can be very, very inefficient, and they have the potential to bring down even a fundamentally solvent bank. Okay, now this insight is very, very crucial to some of the research I've done with my co-authors. So I do want to make sure I clarify where exactly does this panic running come from. And after that, I'll start talking about some of the work I've done building upon this insight. Okay, so see this idea of a panic run. Okay, so let's consider a very simple bank first. Okay, let's look at bank A for the moment. Look at its asset side. Okay, so this bank has invested $50 in cash and it holds $50 in loans. Okay, now $50 in loans here literally means that if this bank were to hold on to these loans for their lifetime, it's going to generate cash flows which are worth $50. All right, now if you go to the right hand side of the balance sheet of this bank, you will see it is funded by $75 of deposits. And for simplicity, let's consider for now all of these deposits are uninsured, and also by $25 of equity. Okay, simple bank here. Okay, here's the first thing I want you to note about this bank. This bank is financially solvent. All right. Now, if all depositors exhibit patience and withdraw money normally based on their consumption need, everything is going to be fine. Okay, banks' assets will generate enough cash flows to pay $75 worth of deposits. All right. Now, but what about the scenario where a large mass of depositors withdraw money at the same time? Okay, is there a possibility of default in that scenario? Okay, so well, to figure that out, you need to think about, well, how is going to bank repay a large mass of deposit withdrawal? So let's say all $75 of deposits need to be paid out right now. Well, how is the bank going to manage that? And you can see bank does not have enough cash. It will need to liquidate some of these loans. So whether there will be a default or not is really going to depend upon, well, how much can they get by selling these loans on an immediate basis at this point in time. And this is where the idea that loans are a very illiquid investment is going to come into play. Okay, so when the bank tries to sell this $50 worth of loan, they're not necessarily going to get $50 for it. Okay, there might be a little bit of a liquidity discount on it, commonly also called a haircut in financial markets. So let's for the moment assume that the haircut on these loans, if you try to sell them, is about 40%. Okay, by that, what I mean is, if you sell a loan that is truly worth $100, you're only going to get $60 for it. All right. So in this example, because of this haircut, the liquidation value of all the assets of this bank is going to be about $80. Okay, you can see this $80 is still above the total amount of liabilities the bank has. It is only $75. So you can see for a bank like this, there is never any need for panic. A depositor knows that even if everybody else withdraws, even if it came down to liquidation of assets, I'll still get my money back. Okay, in a bank like this, you're never really going to see panic. Now, things are going to change dramatically, though, if you increase the liquidity transformation done by this bank. Okay, now the way to increase liquidity transformation done by this bank is either make the bank invest more in illiquid loans, or you can make the bank have more of the financing coming from uninsured deposits. Okay, and Bank B is essentially designed to illustrate this scenario. Okay, so you can see this Bank B over here is identical to Bank A in all respects, except it invests a little more in loans. Okay, instead of 50, this bank holds $80 of loan and only $20 of cash. Okay. Now, again, the first thing I want you to note about this bank also is this bank is financially solvent also. Okay, if everybody exercises patience, depositors withdraw money, its assets will generate $100 worth of cash eventually, and that will be enough to pay off all depositors. But what if a large mass of depositors decide to withdraw money now? Can there be a chance of default? All right. And again, to figure that out, you need to figure out the liquidation value of assets of the bank. And in this case, it's going to be a little bit lower. Okay, it's going to be $68 because this bank is holding a larger fraction of money in illiquid loans. And you can see the total liquidation value of assets for this bank, $68, is below the total amount of deposits it holds. Okay, now do this for me. Okay, put yourself in the shoes of a depositor at this bank. Okay, and for some reason, as a depositor, you believe a large mass of other depositors are going to withdraw money. you're probably going to panic because you know there is a real possibility of default over here. So what you might end up doing is withdraw your money even if you don't necessarily need it. Okay. The seminal insight from this diamond and diptych paper that I was alluding to earlier was that such fears, this kind of panic, can turn into self-fulfilling prophecies. Okay. It can bring even a fundamentally sound bank. Right. This is one of the messages I want to give from this illustration. The other message I want to highlight from this illustration, and that is very crucial to the research that I'll be talking about shortly, is that a bank's vulnerability to panic runs, it increases with the degree of liquidity transformation it does. Okay, more a bank invests in illiquid assets, more of its financing comes from uninsured assets, more vulnerable that bank is going to be to panic-based runs. All right, now with these ideas in place, let me start talking about what are some of the research I've done with my co-authors. What have you found over there? All right. Now, in a paper that I have with Chi Chen, Itai Goldstein, and Chachang Huang, we ask a very simple question. This paper is forthcoming in Journal of Finance. What we ask is, well, to what degree do US depositors exhibit panic in their withdrawal behavior? Okay. The answer here is not at all obvious, given that a lot of regulatory measures are in place in the US economy to mitigate this panic. For example, we have deposit insurance, we have lender of last resort provisions, things of those nature. Now, it may also come as a bit of a surprise to some of you that prior to our study, there is virtually no evidence documenting the presence of panic in depositors' behavior. Why is that? Well, it turns out it's a very, very difficult problem empirically to tackle. What is the reason for that? Well, here's the central problem you have to face as a researcher. Depositors withdraw money not just because they panic. Sometimes they withdraw money also when they are genuinely concerned about the fundamental health of the bank. Okay, they are concerned perhaps the bank's assets will not generate enough cash flows. They're worried about the solvency situation of the bank, in other words. And the problem you face as a researcher is, well, how do you separate the two? How do you separate deposit withdrawals that are triggered by panic versus that result from genuine concerns about the fundamental health of the bank? Okay, so what we do in this paper, and I would say that really is our core contribution in the study, is we find a way to separate the two. How do we do this? Well, essentially, the idea is very simple. Okay, what we do is we compare depositor behavior across banks that are identical in all respects, except for the degree of liquidity transformation. All right. And as I was trying to illustrate with a little example that I had in the previous slide, banks that do more liquidity transformation, they are the ones that are more vulnerable to panic-based runs. Okay, so we're going to compare banks that have exact same profitability, same cash flow generating potential, but have more or less investments in illiquid assets, more or less financing coming from deposits. Okay, how does the depositor behavior depend upon that? So using the technique, we find in this paper that there is significant presence of panic in depositor withdrawal behavior. And in this paper, what we use is basically US bank mainstream data. So we have large banks, middle banks, small banks, they all are characterized with this panic type of behavior in the depositors. Now, of course, we do a lot more in this paper, but let me illustrate the key message from this paper with the help of a couple of pictures over here. Okay, so in this picture, what I'm showing you is a comparison of depositor behavior across banks that hold a ton of illiquid assets. Okay, that would be the orange line. And we'll compare it to banks that hold not as many illiquid assets. Okay, that would be the blue line. On y-axis, what we have plotted is uninsured deposit flows, okay, the degree of deposit withdrawals by uninsured depositors. And on the x-axis, what we have is bank profitability measured by return on assets, right? This black vertical line over here represents the median ROA. So if you are a bank who is to the right of this vertical line, you're probably experiencing times of good performance. Your performance is better than at least 50% of banks in the economy. Okay, so your performance is essentially above median. Now, compare the behavior of depositors across these two groups of banks, when the performance is above median. Okay, you can see the relation is basically flat regardless of how much illiquid assets you have. Okay, this finding should not be shocking to you. Okay, think about this. Depositors do not share any upside from good performance by banks. So when banks are doing well, they don't even care about ROA. And that's why we observe this flat relation over here. Okay, what is striking is, and what is more important is, what happens as the performance starts deteriorating to be below median levels. Okay, and this is where you will see banks that hold a lot more illiquid assets experience a very, very different fate compared to banks that hold fewer of illiquid assets. Okay, you can see as performance deteriorates to below median levels, for the same decline in performance, a bank that has more illiquid assets experiences much steeper decline in deposits at a much steeper rate as well. Okay, and that is the extra bit of difference that we attribute in this paper to a panic-based behavior by depositors. Right. You can also do the same analysis using the other dimension of liquidity transformation. Okay, so like I mentioned earlier, you can do more liquidity transformation either by holding lots of illiquid assets, or you can increase your financing that comes from uninsured deposits. All right, so in this picture, in this paper, what we did was compare deposit behavior across banks depending upon what fraction of their deposit financing is a percentage uninsured. Okay, I also want to remind all of you that this really was the key metric of focus during the recent regional banking pricing episode. Most of the banks that got in trouble essentially had very high level of percentage uninsured financing. Okay, and the message you get from this picture, I would say, is very, very similar to what I showed you in the previous picture. If you look at both groups of banks with above median performance, you will see there's barely any movement in deposit flows, okay? But they experience very different fates as performance goes down to below median levels. Banks that have a high fraction of uninsured deposits, they lose their deposit base much faster rate and a lot more of those. Again, consistent with the presence of panic behavior amongst depositors. All right. So overall, the key message from this paper is, okay, so beneath this veneer of calmness we observe in banking markets normal times, there's a lot of volatility sitting over there. Okay, there's some element of panic residing over there. Now, in the remaining I would say 8 minutes or so I also do want to talk about this other piece of research I have, and then in the end, I will try and leave some time for questions, by the way. So if you have any questions, by the way, feel free to put them in the comment section, and I will try to leave some time to at least get one or two of those, all right? So what do we do in this other piece of research, which I would say is also perhaps even more relevant to what happened a couple of months back in the banking markets. Now, if you think about it, at its very core, panic from depositors essentially stems from depositors' beliefs about different aspects of bank fundamentals. All right. The question is, what shapes these beliefs? Now, whenever I teach accounting to my MBA students, one of the key things I emphasize is the importance of accounting disclosures. Okay, they're central in shaping the beliefs of any kind of investors, including depositors. So natural question you want to ask in the context of banking markets then is, well, how should we design accounting disclosures so that we don't trigger beliefs that create panic? How do we design accounting disclosures so that we have an efficient and a very, very stable banking system? All right. Now, there are many aspects of accounting disclosure you could examine over here. Now, in my other paper with the Chi Chen and Shuyan Wang, what we focus on is a very specific type of accounting disclosure. We're going to focus on loan fair value disclosures. These fair value disclosures were at the epicenter of the recent regional banking financial crisis. And they have been at the source of a controversy going on for a long, long time. Okay, there are people who love them, there are people who hate them, and I'll talk about the debate in just a bit. But at this point, we need a little bit of a reminder about the accounting for loans. Don't get too scared. I will not do this in detail, just at a high level. Now, this is what I teach in my MBA classroom. Okay, so the numbers that go on the balance sheet for the value of loans, okay, they are not fair value. Okay, what goes on the balance sheet are the value of loans that reflect their amortized historical cost. Okay, roughly speaking, what these numbers means is if a bank were to hold on to these loans in perpetuity, for lifetime. Okay, that is the value of cash flows they will get from these loans, right? But that's not what fair value is. Now, fair value numbers, banks are required to disclose in their notes to financial statements. Okay, what these fair values are expected to measure is also a little bit different, right? Accounting guidance emphasizes the notion of exit values. Okay, essentially, here's what banks are supposed to do when they figure out fair value. They are supposed to figure out what would they get if they were to liquidate these loans right now. Okay, that is the fair value of these loans, right? And this focus on exit values is really at the heart of the controversy about the desirability of these loan fair value disclosures. Okay, and I'll talk about that controversy debate and our findings in just a bit. But I think before that, to make things concrete, let's also take a quick look at one of the examples that I have here. The example comes from First Republic Bank, which was, of course, right in the center of the recent crisis. In the top panel, what you're looking at is an extract from their notes to financial statements. Okay, and this is where you will find the fair values of this loan. So let's look at this column, carrying value. Now, these are the numbers that go on the balance sheet. Okay, these are not fair values. Now, the carrying value for First Republic Bank's mortgages is about $136 billion. Okay. Now, if First Republic Bank were to hold on to these mortgages over lifetime, what they expect to make is about $136 billion in terms of cash flows. All right. But what is it that they will get if they were to liquidate those loans right now? That is what fair values are supposed to measure, and that number is available to you in this column over here. Okay. The First Republic Bank tells us at the end of 2022 that the fair value of these loans is about $117 billion. You can see the fair value number is about $19 billion below the number that goes on the balance sheet. Okay, now one of the questions you want to ask right now is that $19 billion different? Is it a big deal? Okay, and the answer is an emphatic yes. Well, how do you figure that out? Well, one way to do that is compare that $19 billion to the shareholders' equity of First Republic Bank. Okay, and that is something I'm showing to you in this bottom panel over here, which I've extracted from First Republic's balance sheet. And you can see the shareholders' equity is about $17 billion. Okay, it's less than this $19 billion difference that I've been talking about. Okay, what that really means is if First Republic had to liquidate its asset right at the end of 2022, the whole equity would be wiped out. Okay, the unrealized losses on fair values are large enough to wipe out their entire equity. Not a surprise, this bank got in trouble. Now, with this example, let's go back to this debate in the piece of research that I've done over here that I want to talk a bit about. Now, supporters of loan fair value disclosures make a very intuitive and powerful argument, something I agree with, something I talk about when I teach accounting as well. Well, the argument is this, okay? It basically says, look, by providing very updated valuations about what a potential buyer is willing to pay, exit values give you a nice forward-looking view of the loan quality. Look, a buyer is not going to pay you much if it thinks the loan quality is bad, so it gives you a nice forward-looking view of loan quality, all right? And that is very valuable information for investors to have out there. Now, critics, on the other hand, I would say also make equally powerful arguments, okay? They're essentially pointing out that exit values can also be influenced by factors that have got nothing to do with loan quality or nothing to do with the cash flow generating potential of loans. Okay, for example, exit values can be lower because of illiquidity discount. Okay, this is something that I was talking about a little bit earlier. Sometimes exit values can go down because a market rate increases, but banks do not pass on these market rate increases to depositor at times. Okay, so sometimes exit values can go down for reasons that have got nothing to do with loan quality. And what the critics are worried about is if depositors lose confidence in response to such declines in loan fair values, you can again have a situation where a fundamentally sound bank might get in trouble. All right. Now, the question really is, where does the truth lie? Okay, does the data support more the supporters of fair values here, or does it line up more with what the critics are talking about? Okay, this really is the main topic of research in the second paper that I was talking about. I believe I'm not going to have enough time to go through all the tables that I had in there, but let me lay out the main findings from this paper, which I think are very, very important. There are three key findings from this research, folks. Number one, what we find is uninsured depositors indeed withdraw money when fair value declines. Okay, now this is not a shocker. The real thing you really want to figure out, well, why is it? Are depositors withdrawing money? Is it because they're concerned about loan quality, or are they simply panicking? Okay, the remaining two findings speak to that. Our finding number two in this paper is, well, they're not concerned about loan quality because it turns out fair value numbers have barely any information content about loan quality. Then the last question is, well, then why exactly are they responding to fair value information? Okay, and the evidence we find basically points out to a form of panic here. When fair values goes down, depositors get increasingly concerned about withdrawals by other depositors, and that is what drives this relation over here. So put it all together, I would say our results in this paper are very, very supportive of some of the concerns laid out by critics of fair value disclosures. Over here, I do want to leave time for a couple of questions as well. So, I mean, in terms of takeaways from this research, there are a couple of things I would highlight. First, this research essentially documents that there is significant amount of fragility that is sitting in the banking system. It seems like loan fair value disclosures are exacerbating this fragility. And potentially there's a case for strengthening some of the regulatory measures to increase the stability of the system. I have a few minutes and I do have a question over here. So this question is, how much do you think has the prolonged interest rate hiking by the Fed affected the recent banking crisis? Well, my perspective on that is it had everything to do with it. Okay, the sudden increase in interest rates took a lot of banks by surprise, and that is what that created these deep losses, unrealized losses sitting in fair values. And as I was talking about you a little bit earlier, these unrealized losses have the potential to trigger panic in markets, and my sense is that is kind of what happened in this recent regional banking crisis episode. The other question that I typically get when I'm talking about some of the research is, well, does this research mean should we eliminate loan fair value disclosures? Is there a case for that? Okay, and my answer to that question always is, well, not so fast, right? And let me explain why. Well, it is true, based on whatever data analysis we did not find any benefit of loan fair value disclosure in their current form. They don't seem to have much information at all about loan quality, and all they seem to be doing is triggering panic in markets. All right, but I think instead of just getting rid of loan fair value disclosures, I think a more prudent path going forward would be to try and figure out, well, why exactly is it the case that we don't seem to have that much information in loan fair value disclosures? Okay, is this something to do with the way we have defined the measurement? It has something to do with managerial incentives, and so I would personally like to see a lot more research on those questions before I'm ready to conclude whether these disclosures should be eliminated or not. All right. Seems like I'm almost out of time over here. I want to thank you for joining me in this presentation today. I also highly encourage you to attend future LinkedIn Live events. I believe they occur on the first Wednesday of every month, right at this time. It's a great forum for faculty to share their research. Encourage you to attend that. Take care.